Dubai's rise as a global crossroads is not accidental. Located between Asia, Africa, and Europe, the city built a suite of attractions for mobile capital: a modern banking sector, easy company formation, world-class real estate, duty-free gold trading, and dozens of free zones that promised low transparency and high speed. Those features, combined with high property yields, an appetite for foreign buyers, and a culture that prized discretion, created an irresistible arbitrage for actors seeking to clean money or hide it from scrutiny. Researchers who studied Dubai's property records and leaked registries found a striking concentration of foreign ownership and opaque corporate structures that mask beneficial owners. But geography and markets only explain part of the story. For years, regulation lagged. Until recent reforms, the UAE's systems for identifying the true owners of corporate vehicles, enforcing suspicious activity reporting, and policing high-value sectors, real estate, luxury goods, and commodity trading, were underdeveloped or unevenly enforced. International probes from the Pandora papers to multimedia investigations like Dubai Unlocked and other reporting repeatedly documented how sanctioned people, convicted criminals, and kleptocrats could acquire assets in Dubai with little public trace. Those investigations didn't rely on gossip. They used leaked property registries, court records, and on-the-ground reporting to show how opacity translated into opportunity. 3 sectors dominate the laundering economy in Dubai. 1. Real estate. Luxury apartments and villas are liquid, prestigious, and easy to purchase through layers of companies. A micro-dataset study of hundreds of thousands of Dubai properties showed patterns consistent with cross-border, tax avoidance, and concealed beneficial ownership, exactly the conditions that let illicit wealth be parked and later monetized. Journalistic databases have since matched convicted criminals and sanctioned individuals to properties in Dubai. 2. Precious metals trading. Gold. Dubai built a huge gold market and became a major destination for gold flows from Africa and Asia. Investigations and trade data analyses concluded that large volumes of small-scale gold, some of it reportedly illicitly mined or smuggled, pass through channels that erode traceability and create money laundering risk. In 2022, reporting estimated hundreds of tons of gold exported to the UAE without proper documentation, raising red flags about conflict minerals and illicit finance. Free zones and corporate secrecy. Dubai and the UAE offer dozens of free zones and one-stop company formation services. While legitimate for global business, these regimes also allowed quick registration of anonymous or nominee-owned shell companies that can buy property, open bank accounts, and move funds across borders with minimal scrutiny. The Pandora papers and similar leaks showed how offshore structures linked to UAE entities shielded dollar-denominated wealth. Money laundering is a 3-step choreography: placement, layering, integration, and Dubai's ecosystem made those steps both cheap and plausible. Criminal proceeds or corrupt wealth are placed into cash purchases, gold shipments, or banked through intermediary companies. Layering occurs through rapid resale of property, circular invoicing via free zone firms, or complex ownership chains across jurisdictions. Integration is the easy part. Sell the apartment, move the gold into legitimate markets, and the funds re-enter global finance as clean. Investigative journalists even documented instances in which real estate agents and developers were told in undercover tests they could be paid in cash or crypto with 0 questions. That's proof of how commercial practices sometimes reduced friction for illicit actors. From 2020 into the mid-2020s, the UAE faced harsh scrutiny from global watchdogs. The Financial Action Task Force issued a mutual evaluation of the UAE's anti-money laundering framework and, while recognising improvements, flagged important weaknesses in enforcement, supervision, and the identification of beneficial owners. Critics argued that improvement on paper didn't always match practice, and NGOs kept pressure on Dubai by publishing data, case studies, and policy analyses. International pressure produced change. The UAE undertook a suite of reforms: new laws, expanded reporting requirements, improved registration of ultimate beneficial owners, and stronger oversight of designated non-financial businesses, realtors, dealers in precious metals, lawyers, and company service providers. In 2023 to 2024, the Financial Action Task Force acknowledged progress, and eventually the UAE was taken off its grey list, an important diplomatic moment that nonetheless left many watchdogs warning that implementation and culture change would be the real test. The beneficiaries are predictable: politically exposed persons who want anonymity, corrupt officials who want safe vaults for stolen state resources, criminal networks that need to recycle cash, and entrepreneurs who monetize opacity, advisors, corporate service providers, some real estate intermediaries. The losers are ordinary citizens in the countries where the wealth was stolen, economies distorted by illicit capital inflows, and international markets that become less transparent and more risky. NGOs and investigative journalists have repeatedly connected the dots between asset ownership in Dubai and social harms abroad, from natural resource plunder to sanctions evasion. Scholars and researchers have tried to quantify the phenomenon. A Bank of England-linked working paper using a micro-dataset of roughly 800,000 Dubai properties found structural patterns consistent with offshore ownership and cross-border wealth parking. Multimedia projects, like Dubai Unlocked, compiled leaked registries that identified dozens of properties linked to people with criminal convictions or sanction records. Trade data analyses tied Dubai to unusually large and underdocumented flows of gold from African countries, a major vector for laundering value. These are not anonymous claims. They are data projects, government evaluation reports, and peer-reviewed work. The UAE's reforms matter. Better beneficial owner registries, stricter reporting, and targeted supervision make laundering harder and riskier. But the structural incentives remain. High-value real estate, busy commodity markets, and the commercial demand for confidentiality will continue to attract wealth, both licit and illicit. Real change requires three things. 1. Transparency in ownership and trade. Public or verifiable registers that link companies to real people and clear documentation for high-value commodity flows. Gold, diamonds, reduce the easiest laundering routes. 2. Consistent, cross-border enforcement. Dubai cannot police global flows alone. Shared investigations, rapid information exchange, and credible prosecutions across jurisdictions deter repeat offenders. 3. Cultural and commercial shifts. Developers, banks, and dealers must be aligned with compliance rather than speed to sale. That means incentives, penalties, reputational costs that make asking awkward questions the norm. The Financial Action Task Force delisting was an important diplomatic milestone, yet independent investigations and data projects show the work is unfinished. The headline, that Dubai became a hub, is not just tabloid hyperbole. It's an empirical description of how particular legal forms, commercial practices, and global demand converge to create an ecosystem attractive to illicit capital. Reform can blunt that appeal, but will require durable, verifiable implementation and real political will. Investigative journalists and data-driven projects changed the debate. From the Pandora papers to Dubai Unlocked and follow-up reporting on gold trading and property ownership, the cumulative effect has been to make once hidden networks visible, and to force a policy response. Those reports are not morality plays. They are empirical dossiers that regulators and policymakers now use as evidence. That is how public pressure becomes policy, slowly, unevenly, but visibly. Dubai's skyline is a lesson in incentives. When speed, secrecy, and profitability outcompete transparency, capital will find ways to repurpose itself, legally or not. For countries that lose wealth, and for global markets that depend on trust, the stakes are consequential. The solution is neither simple nor purely technical. It requires data, diplomacy, commercial redesign, and the patience to see reforms through. For anyone watching this story, the headline is clear. Dubai became a hub because the world gave it the opportunities to do so. And if the world wants that to stop, the same global tools and attention will have to be sustained and sharpened.